In the middle of the market pandemonium, rumors of a stock price that defies the established paradigm and is so audacious, imagine I told you that the probability is higher than you believe. Get ready for an adventure with numbers, predictions, and trends that will help solve the mystery surrounding the pricing of Tesla's stock. This isn't just conjecture. There are significant growth prospects from its current status. In this video, we're providing a well-researched projection on Tesla's stock trajectory in 2024 using sound calculations and fundamental valuation. We'll also talk about market expectations from now until the end of 2024 with the most recent economic indicators in hand and a more transparent Federal Reserve policy. The direction is becoming clearer in the wake of the large company's third quarter earnings. Ultimately, we will examine long-term option positioning in Tesla, evaluating whether the bets are on a rise, fall, or a steady hold of the stock. This insight could provide insightful information, but before we get started, please make sure to hit the like and subscribe button and ring the bell. Without further ado, let's dive into the market insights. Current economic data points to a labor market that is neither overheated nor rapidly approaching a recession. The Federal Reserve, which usually waits for inflation to stabilize at its target rate of 2 before considering lowering interest rates, has unexpectedly adopted a bullish stance that suggests possible policy shifts based on market performance. However, Bostic's insights suggest that the Fed may be more proactive and potentially initiate rate cuts sooner if the trajectory of inflation appears to be aligning with their long-term goals. Expectation is that by the latter half of 2024, inflation will match the Fed's target, paving the way for a more accommodating financial environment in the area of technology sector earnings. This proactive strategy may be a response to economic pressures and the move to stimulate growth, indicating a more dynamic approach to monetary policy than seen in policy cycles. Although Apple has reported a reduction from the previous year, the narrative is still strong despite occasional volatility, and this hasn't led to a wider market setback. The tech industry's overall strong performance indicates resiliency and the capacity to adjust to the current economic circumstances. The market's response or lack thereof to Apple's decline also reflects investor trust in the industry's fundamentals and resilience. Investors appear to have processed and made sense of the earnings reports, maintaining a consistent path despite inconsistent financial results. The response from the collective market demonstrates a cautious but consistent optimism about the tech industry's long-term growth prospects. Recessions are viewed as disruptive forces in the market because of their unpredictable nature and capacity to market volatility during 2022's signal economic downturns, especially on the NASDAQ, was mostly caused by the Federal Reserve's swift rate hikes, which heightened concerns about an approaching recession. In the past, markets have adjusted to rate increases gradually. Cycles like the one from 2005 to 2008 cause markets to become uneasy when tangible indicators of a recession, like a weak GDP or low payroll data, appear. These indicators are the pace and uncertainty of a recession. The level of uncertainty surrounding recession's depth and severity tests the market's ability to withstand negative news. It's predicted that these worries would become more prominent in the first quarter of 2024, possibly causing a market slump and the Federal Reserve to cut interest rates. The outlook for 2023 and 2024 isn't very promising, with forecasts pointing to an economic slowdown and potentially even a negative GDP based on metrics like the Atlanta Fed, GDP, and Out Tracker. Despite these forecasts, the consensus suggests that the economy could experience a sharp slowdown from the 5 growth rate. The current position, which is tactically optimistic, is supported by earnings that haven't caused the markets to move much, with the Federal Reserve providing support, Treasury yields declining, and the expectation of lower inflation. Cautious optimism is balanced with a plan to preserve money in case market drops occur as recessionary fears materialize. While the beginning of 2024 may present challenges, it could also pave the way for a strong bull market as the year goes on. It is expected that once a recession hits and its scope is understood, whether mild or severe, the markets will likely rally, especially in the latter half of the year, benefiting from low federal fund rates and the ensuing increase in liquidity. Sectors sensitive to interest rates, like those related to Tesla, are anticipated to perform well in such an environment. Upon analyzing the market's trajectory, the forecast for the remainder of the year suggests a tactically bullish stance identifying current lower prices, particularly for Tesla, as invest opportunities. As the first and second quarters of 2024 approach, a downturn is anticipated with potential market corrections triggered by growing recession concerns. This analysis leads to a tactical approach of cautious investment with readiness to capitalize on opportunities as they arise. This time frame is seen as a fantastic time to invest, especially since Tesla is anticipated to gain from falling interest rates on both the consumer finance and valuation fronts in the latter half of 2024. Investors are advised to accumulate cash now to leverage any market declines driven by recession fears, even though these are not expected. The outlook for Tesla optimistic with expectations of a strong and bold market, particularly for small and mid-cap sectors that have underperformed recently. Financial advice based on market trends regarding Tesla's 2024 predictions suggests that this course of action makes sense. Variability exists. According to the most recent report, the company can currently produce 2.35 million vehicles, but there are plans to expand that number. Elon Musk has set an ambitious target of growing at a 50-yearly rate, but this growth may not be steady every year, and there may not be a significant spike in growth by 2024. The earnings per share forecast for the first quarter of 2024 appears likely to surpass Wall Street's more conservative delivery estimates of 2.1 million vehicles. The following quarter has been adjusted downward to reflect the challenging task of predicting Tesla's financials amid expansive projects like the potential construction of Giga Mexico. In recent months, Tesla's EPS expectations have also dropped from $4.80 to $394. Despite this downward revision, the lower EPS forecast could make Tesla even more alluring investment, even though it complicates the valuation process. When estimating Tesla's earnings per share for 2024, the primary focus is on its car business, which is considered the most significant factor, while acknowledging that the energy and services sectors are also crucial. Simplifying the analysis of deliveries and margins is the chosen approach because it has proven accurate in past delivery predictions for Tesla. For context, this dynamic market scenario highlights the importance of staying informed and ready to act on investment opportunities as they arise. This is with an ASP of $19.625 billion for Q3 2023 and $435,500 per car in 2024. A number of things could affect this figure. Lower interest rates could result from a reduction in interest rates by the Federal Reserve, enabling Tesla to boost car prices in the future because of lower monthly payments. $5,000 hypothetical price increase might lift the ASP to about $51,000. Additionally, individuals may be able to tolerate price hikes of up to $7,500 thanks to the Inflation Reduction Act tax credit, giving Tesla the freedom to change pricing while maintaining affordable monthly payments. Assuming a middle-of-the-road ASP of $53,000 and anticipating 2.3 million deliveries, total revenue could reach $122 billion, representing a significant increase in revenue. After subtracting the anticipated $37,500 cost of goods sold each vehicle, the profit per vehicle would be around $15,500. A total profit projection of about $35.6 billion obtained by multiplying this profit by the number of deliveries. However, these estimates are subject to considerable variation. For example, if Tesla had 3 billion shares and all other variables remained the same, the EPS would be approximately $188, an unlikely scenario. Taking net margins into account, roughly 55, the EPS would be about $644, which would be significantly different from Wall Street's current estimates. Most analysts do not believe that Tesla car prices will rise in 2024, but the company's latest earnings call revealed that affordability of monthly payments is a key component of Tesla's plan. According to this insight, Tesla might actually hike prices in contrast to what the market is now anticipating if interest rates decline. This analysis shows a scenario in which, if these conditions materialize as anticipated, Tesla's 2024 EPs may surpass current projections. Elon Musk's focus on the affordability of monthly payments, independent of the total cost of the vehicle, raises the possibility that Tesla will raise prices when borrowing becomes less expensive. This pricing flexibility is seen as a crucial component of Tesla's business strategy, particularly if interest rates decline and make loans more accessible. Examining the Cautious Wall Street EPS forecast from 3 months prior, which was approximately $5 with an EPS of $4.80 and a forward price to earnings P ratio of approximately 58. Tesla's potential stock price for the upcoming year is estimated to be around $278,840. However, given that the current P is approximately 70, more reasonable expectation might be higher of Tesla's forward. P were to reach 90, reflecting significant EPS growth and lower interest rates. In a scenario that is both cautious and hopeful, Tesla's stock may hit new highs, perhaps as high as $432. Two freight cut may yield an EPS of $515 and a P ratio of 75, which would translate into a stock price about $3, 8,625. This would be an increase, providing Tesla increases pricing gradually and effectively controls growth expenditures. In the worst case, an EPS closer to the current $394 Wall Street consensus may be expected. The stock price might be about $275, $180 if this were multiplied by a P of 70, which would account for no price hikes. Decline in demand and delivery quantities falling just short of the 2.3 million mark. Target, on the other hand, estimates that the stock price ranges from about $432 to $1,486 in the best case scenario, taking into account an EPs of $540 and a P ratio of 80 to 90 that acknowledges Tesla's price rises and stable demand. If the EPS were to reach DOE 6 and the P hit 90, the price could fly to 1,540. These projections highlight the importance of Tesla's EPS in determining the company's stock price. The forecasts show that Tesla's stock price has the ability to greatly surpass its existing value with a range from modest gains to reaching new highs. The uncertainty centers on future spending mark outcomes and average selling prices. Tesla's present market price of about $1,220 is considered a good opportunity to purchase, but by the beginning of 2024, a period of weakness is anticipated because to recession worries and the market's propensity to overreact to new cycles. Despite this, simple calculations using the company's earnings per share EPS and the price to earnings P ratio are used to project Tesla's pricing by the end of the year. The analysis considers a scenario in which Tesla's P ratio, which is currently at 70, might considerably improve given the current 5-point federal funds rate. This improvement is anticipated as a result of a number of variables, including Tesla's price rises, improved margins, and anticipated decline in the Fed funds rate. According to the reasoning, the long-term option may not completely capture the rising potential in Tesla's stock value due to conservative projections. This concludes our in-depth analysis of Tesla's financial forecast and stock potential. The market is noticeably bullish on the company, with significant call activity observed for various strike prices up to 2025. Beyond that, the calls greatly outnumber the puts, displaying a 21 ratio that highlights the market's optimism regarding Tesla's future performance. We've looked at the variables that can raise the price of Tesla stock, like higher growth rates, profitable margins, prospective price hikes, and lowering Fed funds rates, even in the event that early 2024 market jitters result from recession worries. Given the available options, Tesla's long-term outlook seems optimistic. The market is now showing signs of robust growth, and we'd love to hear your comments. How do you feel about the possibility of 2024 pricing rises for Tesla? What effect do you think the Fed's interest rate decisions will have on Tesla's shares, and will you be modifying your investment strategy in light of these forecasts? Please share your responses in the space provided below. And don't forget to we appreciate your time and hope to see you in the future video. For your daily fix of incisive market analysis and stock updates, subscribe to Tesla Hype